We're live. Live everywhere. Oh, that pulses. That is strange. But that is okay. Look, it's full screen me. Wow. I need to make sure. Oh, yeah. I'm very unprepared. Very unprepared for today. Professional. Professional, by the way. And shop for a top. All right. Hello. Welcome. Welcome to the live stream of all live streams. We're live. Bet you didn't know that. Teach me your ways, a wise one. Invest in Bitcoin. I'm just kidding. Don't do that. That's a bad idea. Hello, Lucas. Lucas, my Lucas. Oh, hey, I'm full screen. Merry Christmas from my house to yours, brother. It's like we're a professional stream here. 0.01 Bitcoin. That's so tough. I remember. So here's the thing, right? I mined Bitcoin in 2017. I mined Bitcoin on a PC, on a laptop. I do not know where that laptop is. I do not know how much Bitcoin I mined. I doubt it was very much. However, maybe one day we'll do a stream where I'm looking through my old laptop and see if I can find my Bitcoin that I used to mine. Tragically, I know not where it is. But neither here nor there. We're talking. We got so much to talk about, dude. Um, Actually, I have a lot to talk about. By the way, um, brother, I uploaded a video yesterday. This always happens to me. The market can be irrational longer than you have money. True. Um, this always happens to me. I have finance channels. I have multiple. Of course, I have this. I have dollars and cents. Yeah. The videos that I upload that are not finance related are always the best performing videos on every channel. So, dollars and cents. The most viewed video on dollars and cents was about Disrupt TV, which is kind of finance adjacent, but it was specifically about how, like, I think this dude's probably, he's trying to pull a fast one. Basically, I think that he might be trying to scam his fans. It was more so, not so much finance related. And so I uploaded a video on Firefox yesterday. The title is Firefox is abandoning its users. It already has more views than all of my other videos. It is my most viewed video, and I uploaded it yesterday. um, which is well, okay. If you count shorts, technically not, but shorts don't count. I think. Um, so thanks so much everyone who went to go watch that video, who liked and subscribed, and all of the haters too. There's a guy who was very upset with me in the comments section of that video, which was very funny. But um, Every time I read that comment, it's so great. Where'd that other comment go? Oh. Anyway, yeah. So stuff is happening. I've stuff to talk about. First of all, what's happening today? What's happening in my portfolio? 4-dimensional therapeutics falls another 3%. Wow, I've lost monumental amounts of. I lost 33% this month. I continue to lose monumental amounts of money on 4-dimensional therapeutics. Professional investor, by the way, 3% on MJ. Ooh, 4% on Beyond Meat. Tragic, brother. It's all going down. My largest position is up 0.5%. Intel, good lord. Intel is being buoyed by NVIDIA taking a $5 billion stake in Intel. They agreed to this in September, and they finally actually went through with their purchase. They got regulatory approval for it. And they're paying $23.28 per Intel share. So every single share that Intel is buying, they're buying $5 billion worth at $23. Intel right now is trading at, I think it's $36. So they're already making some money. They got a $13 arbitrage per share on $5 billion worth of shares. Very good deal. So they're making out like a bandit in that deal. But that's neither here nor there. What else is going on? Boston Omaha's flat. Bonds are relatively unchanged. You know what is kind of crazy? Gold and silver. What is going on over there? I want to check that out real quick. Because silver is down 8% today. Yo, who blew up? That's crazy. It went from $72 down to 64, 65 now? Bro. Also, look at that chart. A precious metal doing that? Kind of scary. Same thing with gold. Gold's down 4%. These are precious metals, by the way. These are not like random biotech stocks. This is like metal. Like the stuff that you pull out of the ground metal. Gold, by the way, the last time gold went absolutely parabolic. Oh, this is gold futures. The last time silver went parabolic was 2008 to 2011. I can now make jokes like that. Gold. Although I do think it's good. It's good to have a correction every once in a while. If your precious metals are going up 500%, like we need to chill here for a minute, okay? Okay. Good job, guys. Yes. So, precious metals are pulling back a little bit, which is probably healthy for the market overall. Anything else on the watch list that's interesting? The market is down. Nvidia is down 2% today. Usually we have a Santa rally. Typically from Christmas until the New Year, stocks only go up. It's called the Santa rally, for those who may not know. We're not getting that this year. It's been canceled. Instead, we're only getting coal. We're going down, which is not It's not incredible. Anyway, um, another bit of another kind of story that I'm not going to cover in depth, but I just want to kind of glance over it because I think it's absolutely hilarious. Um, this happened last week, I think. The If you don't know, there's this company called Trump Media and Technology Group. They they run a social media company called Truth Social, and they've decided that they're getting into a new line of business, which is fusion energy, which seems in line with the company's values, I think. Um, the company announced that Trump Media announced a $6 billion merger with fusion company Tay Technologies. The stock goes up 33%. So anybody this is a private company. So Tay Technologies is a private company that is developing a new fusion technologies that nuclear fusion, basically. It's cool stuff. They have, by the way, they do not have any like technology, to be clear. They don't actually have a product. They just have they have like concepts of a product, to quote a kind of a famous guy. It doesn't, I don't think it makes a lot of sense, to be honest, but um yeah, for the most complex problems, they're working on hydrogen boron fusion energy. Uh which, like, cool. Um the stock, ever since the announcement, the stock has fallen quite a bit. It rose 53% and has since fallen 16%. On the basis of a social media company merging with a nuclear fusion company typically is not necessarily what investors want. I think it's, now granted, I will say one thing. Um, it's a good idea that the CEO of the social media company, who's not Trump, by the way, not anymore, the CEO of the social media company is not going to be the CEO of the fusion energy company. They're going to have two CEOs. So Trump Media Technology Group now has two CEOs. The CEO of Tay Energy is taking over as co-CEO, and he's going to run the energy portion, and the social media guy is going to run the social media portion, which is very funny. But one other thing that I noticed in this sort of kind of weird, all this very weird stuff that's happening, the homepage for Trump Media and Technology Group, they have they of course have an investor relations page so that anyone who wants to invest in the stock, which has fallen quite a bit, especially over the last 5 years. Obviously it was a SPAC, and it really isn't that far above its SPAC price from 4 years ago. But anyway, you can go and you can read all about it. Trump Media and Technology Group. Also, I don't like the drop shadow on this. As a professional myself, I think the drop shadow here could be a little bit better. But anyway, I noticed something kind of strange, and that is, they misspelled filings. $4 billion company, by the way. This company's worth 4 billion. It's worth $3.7 billion. They can't even spell filings right. What is happening? This is a bit of a nitpick, I will say, but I just thought it was funny. Guys, we need to check these things. I'm gonna email these guys. Be like, hey, oh, they spell that right here. Unacceptable. This makes me want to not invest in your company. Anyway. Yeah, so now, along with DJT, which is the ticker for that Trump Media and Technology Group, you can also invest in Oklo. It joins Oklo, which is another company that has no product. And it exploded. Well, it's down 53%. Another Oklo is a company that is developing nuclear fusion technology for the next generation of nuclear reactors. They do not have a product. They have negative net income because they have no revenue, I think. But anyway, so that's kind of a fun, funky thing. If nobody heard about it, you can invest in yet another no product nuclear energy company, and as a result, you also get part of a social media company. Because why not? SoftBank's acquiring Digital Bridge, by the way. I heard about this. I don't even know what Digital Bridge is. What is it? Digital Bridge. They're up 10%. They're not getting much of a premium. Digital Bridge is a global infrastructure investment firm. The company owns, invests in, and operates businesses such as cell towers, data centers, fiber, small cells, and edge infrastructure. Wow. Okay. Is there any other thing? Oh, yeah, Cantaloupe. When is this deal closing? Cantaloupe is being bought out by somebody. I forget who it is. Yo, this Cantaloupe gets more and more attractive every day. $365 retail markets. $11.20. No, I did not want AI mode. $11.20. There's now a 60-cent premium on shares of Cantaloupe. What is that? 10% would be $1. It's 5%. It's not much, but it's not bad, I think. Whew, getting out of there. Okay. We're going to talk about something sort of big. Oh, yeah. I also wanted to look at this. Lululemon. Chip Wilson. Coming out of nowhere. So, the dude that founded Lululemon is a dude named Chip Wilson. And the company has done fairly well over the last couple of years. I actually made an entire video on it, on why I think it's not, like, dead. Despite the fact that Lululemon has gone basically nowhere for the last 5 years, down 40% over the last 5 years, up 1,000% since it went public, though, 2007, 20 years. Last couple of years has been a very bad stock to own, despite the fact that it's growing still quite rapidly. It's a good example of multiple compression. Either way, Lululemon, the founder of the company, who stepped down a couple of years ago, is now launching what's called a proxy fight against Lululemon because they want to the current CEO of Lululemon is stepping down, and so the founder of the company wants to basically install a new CEO, which is insane, but you know, One of the nominees are former On Running co-CEO Mark Moyer, ESPN Chief Marketing Officer Laura Gentile, and former Activision CEO Eric Hirshberg. Yo, Eric Hirshberg, that guy does not know what he's doing, I think. I feel like Eric Hirshberg was pushed out a long time ago for very good reasons. Also, you want to talk about a company that has had like a meteoric rise over the last couple of years. This might actually be the On Running. This is a running brand. I don't know if you know. All the real runners know what On is. I've actually never. On is one of the only running brands I've never owned a pair of shoes from. I've owned Hoka's, I've owned Brooks, I've owned Adidas, I've owned them all. Never On. Woozers. Okay, Lululemon founder Chip Wilson launches proxy fight for board shakeup. Chip Wilson, by the way, owns 9% of Lululemon still. Lululemon Athleticus founder Chip Wilson said on Monday he has launched a proxy fight by nominating 3 independent directors to the company's board, days after the apparel maker announced the exit of CEO Calvin McDonald. Calvin McDonald has overseen, I think, a 10x growth in revenue and massive growth in profit, and basically every vertical the company has entered, it has succeeded in, and now he is as Alexander, weeping, for he has no more worlds to conquer, and now he is retiring. Lululemon shares have shed nearly half their value this year as the company struggles to find its footing with younger and affluent shoppers while battling stiff competition from other fast-growing rivals. Wilson has nominated all of the directors. Interesting. He's nominated 3 director candidates to the board, including former On Running co-CEO Mark Moyer, former ESPN chief marketer Laura Gentile, and Eric Hirshberg. The recent CEO change announcement was the 3rd total failure of board oversight. This is tough. The recent CEO change announcement was the 3rd total failure of board oversight with no clear succession plan in place. This is a legitimate criticism. Shareholders have no faith that this board can select and support the new CEO without input from a board with stronger product experience. Valid point, Wilson said in a statement. Earlier this month, the company said CEO McDonald would step down in January, joining a long list of leadership shakeups across global consumer companies and retailers. I talked about this a while ago. And I made a video about it if you want to go watch it. It was pretty bad, but it's called Major CEOs Are Jumping Ship. And I talk about how CEOs from Harley Davidson to, I don't know, who else is stepping down. Anyway, tons of CEOs are stepping down. Lululemon is joining them. Wilson has spoken to Nielsen, but believed Lululemon shareholders would not trust any CEO who's picked by the current board, and thus wanted to change the board first. Wilson has a 4.27% stake in the company. The interim CEO is Megan Frank. Oh, they're co-interim CEOs. That's how you know that the company had no idea that they were had no idea what they're doing. That their interim CEO is co-CEOs. He founded the company in 1998 and was with it till 2012. Very well. Who are the biggest? Who are the biggest shareholders of Lululemon? I know Michael Burry owns quite a lot. Or at least he did. Percent ownership. Dennis Wilson. Who are you? Who's Dennis Wilson? Oh, it's Chip Wilson. He owns 8%. His real name is Dennis. Fun fact. Geode Capital owns everything. I'm telling you. Flossbach von Storch. Imagine Flossbach von Storch. It's a bank. Flossbach von Storch is Germany's largest independent asset manager. Okay, well, that makes sense. So there aren't a ton of like independent investors that own. The vast majority of Lululemon shareholders are owned by the big ETF providers, which makes sense. He sold 110,000 shares. Lipo Investments. What do you think those guys do? Wait, what? Lipo Investments is an investment vehicle owned by Chip Wilson. Which owns how much? Another 8. Okay, I'm not going to think about that anymore. However, Lipo Investments, so Chip Wilson effectively has like 16% of the outstanding shares of the company, which is kind of impressive. That especially for what is it? It's like 30 billion, right? It's $24 billion. That makes him over a billionaire. Wow. But either way, he's pushing for some stuff, for some changes on a view one of their presentations. It's been a while. We're gonna quickly look through this on Investor Day 2023. Why? They haven't done an Investor Day since. Give me quarterly results. Press release. Okay, this is nothing. How's On Stock doing? On. It's down. I remember looking when I started looking at this company. It was like 2024. How was what's On's competitor? Deckers Outdoor. Ooh, wow, what a fall. 50%. Deckers owns Uggs and Hoka, by the way, if you did not know. What a fall. 15 PE ratio. Okay. These are retail companies, though. So 55 PE ratio? Okay, so this company does not do much in profit. Driven by exceptional global momentum and consistent execution on its strategic priorities, On delivers record net sales and profitability in the third quarter. Net sales increased by 25% and 34% on constant currency basis. They lost 10% in currency? Yikes. They lost 10% on currency transactions. That is so tough. They have 924 million, what is this, francs? Can I get just like a, all right. Oh. Nope, not doing that. Yeah, financial statement. Net sales up 25%. Constant currency is up 35%. Crazy. That is kind of crazy. Yes. Where are they growing the fastest? Asia Pacific. They've doubled their revenue in Asia Pacific. Insane stuff. With accessories leading the charge at 150% growth year over year. Although, granted, that's not much. The majority of their actual revenue is coming from shoes, obviously. This is On. On sells 700 million. Wait. On sold $700 million worth of shoes. Wait. They sold $1 billion worth of shoes. Not $1 billion worth of shoes. They sold $1 billion across their company. And this is just a 3-month period. They've sold $2.5 billion worth of shoes? Where? To who? That's crazy. The vast majority of that's in America, too. Okay, well, hey, you know what? Good for them, I guess. What is okay, so surely Deckers has... Surely Deckers sells way... They have Uggs and Hokas. Surely they do way more than this. Latest 10K. They have $2 billion in cash. How much? What is their company worth? $15 billion. All right, good for them. They have a lot of debt. A lot of that is long-term lease obligations. That's $275 million. That's not much. Wait, do these guys not have any debt? Anyway, this company does less in revenue than... No, it does more in revenue. I'm forgetting. This is 3 months versus 9 months. Are they going to break it down by brand, please? It's so crazy to me that On Running is doing almost as much revenue as Deckers' entire company. And Deckers has more than one brand. Anyway, that's enough rabbit holes. I think we're going to get on to the main event. How many of y'all like freedom? Because that's what we're talking about. We're talking about freedom. I'm debating if I want to put on my jacket for this or not. Do we think it's a conflict of interest? Nah, we'll keep it off. Okay. Introduction. The U.S. stock market has performed very well this year. Year to date, we're up 17%. This is an exceptional year. An exceptional year. Genuinely. However, while the United States has seen tremendous growth led by mostly AI companies, the rest of the world has also seen incredible growth. So US stocks have actually lagged global markets this year. So this is a chart that basically demonstrates US returns versus global equity returns. So if you were to invest in just the United States versus if you were to invest in just the rest of the world. So as of when this chart was made towards the tail end of 2025, if you had invested in the rest of the world, you would have made about 10% more than if you had invested in just the United States. So the United States went up 17%, the rest of the world went up about 28%, at least in 2025. Now, granted, the United States generally outperforms by very large margins the rest of the world, apart from some periods of time. But generally, the United States has been a bastion of outperformance. UBS writes daily. UBS has a nice little blog that sometimes has some good investing insights, and they talk about some of this. This was from a couple of days ago. This was from the 18th of December, where they talk about sort of AI investment is continuing to grow and probably will continue to grow over the next couple of years. U.S. equities probably have a little bit further to run. They estimate about 7,700 for SPY by the end of the year, by the end of next year. And then they talk about emerging markets a little bit. So China remains attractive. There's been a correction in tech in China, and it's seen the Hang Seng Tech Index fall about 19% since its early October highs. They believe that there could be an opportunity there to invest in Chinese technology equities and maybe make some money, especially because they expect CapEx from the major tech companies to grow 26%. And as CapEx grows, assuming that a lot of these companies can continue to turn that CapEx into revenue and profit later on, it's likely that they might rebound. Another thing that they highlight is European equities is recovering. European equities haven't done amazing this year, but with the strength of the Eurozone and specifically in Germany with defense spending and other spending, with defense and infrastructure spending, they expect that the European equities will rise as well. However, there's a problem. Typically, companies that are more under autocratic control typically do not perform as well. Specifically, these are emerging markets. So, real quick primer. An emerging market, there are three kinds of markets. There's developed markets, there's emerging markets, and then there's frontier markets. These categories are used to as shorthand for how developed a country is in terms of their market, let's say. So a very developed market like the United States is a market that has very high liquidity. There are very strong controls in place where you can catch fraud, and companies aren't like just like outright defrauding their investors. There's a lot of liquidity in these markets, which means that you can trade in these markets. So, like for instance, Nvidia, $5 trillion market cap. There are hundreds of thousands of shares that are traded every day. You get a lot of liquidity. You can get in, you can get out. You're not stuck in a position if you manage to get a position. Emerging markets are the in-between between obviously these developed. They're less developed. They're less developed than the highly developed nations like the United States, the UK, and all these. Emerging market economies, these are countries like Poland, like Chile, like China, and Hong Kong, Taiwan, South Korea. These are countries that are very quickly becoming developed, and they are bolstering the ability to invest in these countries. And just like in general, they're making strides to make life just better in these countries. Frontier markets, of course, are the bottom of the barrel. These are your Irans, your Syrias, your Democratic Republic of the Congos, your, I think Turkey's in there. Turkey might be an emerging market at this point. But these are frontier markets are very hard to invest in. They're very illiquid. They typically have autocratic governments. They're very scary places to invest because, like for instance, Russia for a very long time was considered an emerging market, and they've been downgraded to a frontier market because it turns out that the country can just come in and suspend all trading on the stock market, and that's just not good. You just can't have that, and so they were doing increasingly better, and then they just decided to blow it all up in more ways than one. So emerging markets are a great place to invest typically because you get a little bit more of the safety and security than a frontier market, but you still get a lot of that growth that you don't typically find in a developed market. Unless you're talking about the United States, in which case growth is forever and always. But anyway, so a lot of investors seemingly like to flock to emerging markets, especially when the United States is sort of up in the air about some stuff, especially right now. There's a lot of turmoil. There's a lot of talk about U.S. risk, about specifically U.S. risk, where you don't typically... The U.S. is becoming less and less a good place to invest, just because of the sort of erratic nature of a lot of the policies that dictate what this country is actually doing. And so more and more investors are going outside the United States, and they're going to these emerging markets. As you can clearly see, the United States has had a great track record, but this past year has seen wild outperformance on the global stage. And so for a very long time, let me see if I can actually pull this up. Emerging markets ETF. The biggest emerging markets ETFs all are typically market cap weighted. So IEMG ETF.com. So IEMG is one of the largest ETFs that holds emerging market companies. I would like to get a holdings breakdown. Holdings. And then can I filter by... I wish I could filter by country. Hang on, technical difficulties. Why is ETF.com so bad now? This looks terrible. ETF.com used to be so good. Holdings. All right, can I get countries? I cannot. IEMG holdings by country. The vast majority of these holdings are in Asia. Top 10 countries. Okay, here we go. Here's it. Top 10 countries. The 25% of the portfolio is China. So because China is sort of the largest of the emerging markets, a lot of people, it's obviously the highest weighted. So if you're going to run an index like this, you're going to invest in the companies and the countries that have the largest market caps. So it's just market cap weighted. So China, of course, becomes the largest country in basically every emerging markets portfolio because China is the largest emerging market. It will very likely become a developed market in the next couple of years. Despite the fact that it has been an emerging market for the last like 25 years, it seemingly can't get out of the emerging market status for a more fully developed market. But anyway, you typically get like China and India and Brazil in these emerging markets portfolios. The problem is companies like China and India and Brazil and Saudi Arabia are all, they're pretty locked down countries. They don't exactly have a ton of freedom in terms of what people are allowed to do, especially in places like China and Hong Kong. And so there was a company that sort of recognized this, and they said, hey, what if we build an ETF that gets all of the emerging markets and we rank it by how free those emerging markets are? And so this is where Life and Liberty Indexes comes in. This is something that I have followed and been in. Disclaimer, I have followed them for a very long time. I am personally invested in the Freedom 100 Index. Because I think it is genuinely a good idea, and I think it is worth taking a look at, and so that's why I'm talking about it today. So the Life and Liberty Indexes, basically, they said, hey, what if we go around to all the emerging market countries and we rank them by how free they are? Obviously, they're not doing any of the ranking. They're pulling data. So their investment philosophy: freedom weighting, quantitative, personal, and economic freedom metrics are primary allocation drivers in our investment process. Top-down approach because governments are best positioned to protect freedom. Freedom metrics are most effectively captured on the country level and comprehensive freedom metrics. Freedoms are interconnected. Civil, political, and economic freedoms work together and should be measured as a composite. And then, and the other really cool thing about this ETF is they take out all of the state-owned enterprises. This almost alone makes it worth investing in because the vast majority of those Chinese equities, this is genuinely maybe one of the biggest risks of investing in these emerging markets, is like Tencent is owned by, the majority of Tencent is owned by the Chinese government. Alibaba, they just disappeared the CEO at some point. He came back, obviously. Chinese Construction Group, Bank Group, is basically entirely owned by the Chinese government. Xiaomi, again, very heavily invested by the Chinese government. And if these companies are not directly owned by the Chinese government, they have massive loans that are from the Chinese government. And so there's some control that's exerted there, no matter what. You can't really escape the sort of state ownership in any real capacity. And so that's a tremendous amount of risk that you're taking on, because it's like the country could just decide, especially with China, the country could just decide that they're changing things, and all of a sudden you have like Alibaba. Baba's a great example of this, where the Chinese government, Alibaba was going to get Ant Group to go public. This was a couple of years ago at this point. I remember when they were trading, in these, there was a lot of hype around this company, and then Alibaba they have a finance division, which was Ant Holdings, and they were going to spin it off, and they were going to IPO it. And the Chinese government basically stepped in and said, you're not going to do this. And so that led to a titanic fall, like 80%. And also China started to lock down a lot of their sort of technology sector a lot over the next couple of years, with harsher penalties. And obviously we saw Jack Ma disappear for like 9 months, and that wasn't great. around the time Ant Holdings was going to go public too, which again, not great. You typically don't want to trust all of your money in those places. But anyway, Life and Liberty Freedom 100. There's 24 emerging market countries, and they rank them by how free they are. Obviously, these are some of the metrics: civil, political, economic. How much violent conflict, how much terrorism, how many disappearances are there, torture, women's freedoms, rule of law, due process, internet freedom, which automatically discounts China, obviously, freedom of expression, religion, the press, assembly, and then you got the legal system, soundness of monetary policy, which also I think excludes China automatically, freedom to trade internationally, that almost excludes the United States, business credit and labor regulations, level of government interference in private markets, again, completely excluding China. All of this data is provided by the Fraser and Cato Institute, which you can go and you can read the Human Freedom Index 2024. This is a report by the Cato Institute. You can go and you can read it. It basically pulls all this data and ranks countries based off of basically the same things. And you can see Switzerland is the most free country. Switzerland, New Zealand, Denmark, Luxembourg, Ireland, Finland, Sweden. And so you can take all of these and you can take out and you can just throw away all of these sort of more developed markets. So like Switzerland is a pretty developed market. Denmark is a pretty developed market. Luxembourg is probably an emerging market at this point. But Finland, Sweden, Iceland, a lot of these are more so developed markets. Japan, of course, Germany, Netherlands, the United Kingdom, and the United States up 4 places in 2024. This is we don't have 2025 yet. I expect it maybe to go down a little bit, but freedom score changes up 0.29%. Good job, United States, going up 4 places in the top 20 again. Good for them. But then you get all the way to the bottom. And these are, of course, going to be your frontier markets. So like your Syria's, Yemen's, Iran, Myanmar, Sudan. If you can even invest in these countries, it's very scary to do so. Is there a Myanmar? I think there's a Myanmar ETF. No. There's not a Myanmar ETF. Yeah, you can't even really invest in these countries. You can technically invest in Iran. There's one private investment firm that allows you to buy some equities in Iran. Not that I would ever really want to do that. Where's China on here? Surely it's not super high. China, 150th. Hong Kong fell 10. Obviously, Hong Kong fell 10 spots. It kind of got invaded by China. China makes it to 150. China's not doing so well in terms of liberties. So and the best part about the Freedom 100 index is after a certain point, you just get cut out of the ETF completely. So this ETF does not allow you to invest in China at all, because their human rights score is so low that you just get cut out of the ETF completely. But anyway, we'll go through this is their actual investor presentation. We're gonna walk through this real quick, and we're gonna get sort of the value add for what they're looking for. And what they're doing. Over the last few decades, emerging market stocks and U.S. stocks demonstrated significant cyclical shifts in performance. Typically, as United States does less good, emerging markets do good. But the problem with emerging markets, one of the big problems with investing in emerging markets is sometimes they just kind of like blow up, which isn't great. Like China. EEM is another big. Yeah, sometimes, 2008, sometimes you just blow up, down 60%, 2020, down another, 40% or whatever. Sometimes sometimes you just blow up. You know, a country that has a very large weighting in the yeah. So if there's a big crunch outside the United States, especially if you get something like 2008 where the entire world's affected by it, then you get real big problems. Valuation gap. This is another sort of big thing. CAPE ratios, a very popular valuation method. But you know, you sort of have a lot of emerging market countries trade at relative discounts. Obviously, because they're emerging market countries, they have to trade at a discount. And obviously, the United States is going to trade at a premium because, you know, it's the United States. Why not? This is all of the emerging markets that are currently, well, as of 2023. But it talks about, it's actually an interesting chart talking about the countries that have been promoted into emerging market status and have gotten taken out. It looks like, I think Israel in 2010 became a it's been one of the very few countries that have been promoted from emerging market to I totally forgot what it was called. Developed market. So Israel's a developed market. Russia got annihilated out of the out of the emerging markets. I wonder why. Turns out when you shut down your stock market, people can't invest in your stock market anymore. It's tragic. And this is what I was talking about. You have the autocracy drag, and this is a sort of uniquely emerging markets well, not so much anymore, but case study number 1 of Russia, once accounting for 10% of the MSCI, this is EEM, this is what we're looking at. Once accounting for 10% of the index, Russia's weight has fallen to less than 2% by the time it was removed. And because, you know, Russia just isn't a great place to invest because they just don't have the freedom, you know, at the end of the day, the market is a very powerful thing, and it's very hard to overcome just like market dynamics. And so when you have countries that try and come in and exert very strong levels of control over sort of the free market, it just doesn't work out. Case study number 2, China. China has become a large emerging market economy. Long-term returns to investors have been muted and volatility has been high, which is not great. I do not like volatility. I'm a scared boy. China's annual returns 2%. Max drawdown. Imagine losing 90%. Meanwhile, if you go throughout the rest of the world, the annual returns is about 7%, and the max drawdown is 65%. So not only are you getting better returns by going to the rest of the emerging markets, but you also get less volatility, which is just a good thing to have. And this is the divergence of freedom across emerging markets. So your sort of Czech Republics, Taiwan, Chile, and Korea are very high in terms of freedom. And we'll actually take a look at this in a little while. The countries with the countries with the most freedom tend to have the best stock returns, and the countries with the least freedom have the worst stock returns. It's almost like a perfect chart. The benefits of freedom, obviously, more economic freedom, higher life expectancy, more freedom. You have, you know, more GDP per capita. Literally, as you get freer, your GDP goes up. It's great. It's just great. Freedom-weighted emerging market equity. This is their value proposition. A review of 700 academic studies showed there are 50% linked to economic freedom to positive outcomes such as faster growth, higher incomes, and improved social indicators. And then, of course, there's all this, which we talked about, which is the quantitative measures of how free a country is. Very important, very, very important. Companies with 20% or more state ownership are completely excluded. Minimum country level capitalization requirements must be met for inclusion. So you have to have some degree of liquidity. You can't be like in Iran where there's one investment firm that is allowed to go in and purchase any sort of equities. And also another sort of subtle thing, which is kind of cool, 8% cap on any security weight. So there's no single stock is more than 8% of the portfolio. If it does become more than 8%, it just gets sold and put into other stuff, which is great. And this is the difference between the two major. This is really important. This is the difference between the two major emerging markets ETFs right now. So MSCI's emerging market ETFs, EEM, I believe this is EEM. 32% of it's in China, 20% in Taiwan, 15% in India, and then 11% in South Korea. Whereas if you rank purely based off of how free the country is, you get Taiwan at 21%, South Korea at 19%, Chile at 19%, and then Poland at 12%, and Brazil at 7%. Brazil has gotten a lot better. Actually, let's go back to this Cato Institute thing. I feel like Brazil has gotten a lot better. Brazil has gone up 5 places in the last year. Good for them. Brazil is becoming a lot better, I think. Either way, they only invest in 12 of the countries, 12 of the emerging market countries, which, like, fair enough. Top position weight, Samsung Electronics is at 10% just because it's gone up so much so quickly. It just hasn't gotten rebalanced yet. Another kind of cool thing about this is it gets rebalanced every year. So you're not like, it's not, your turnover isn't like super, super high. Also, your expense ratio is a little bit high. It's 0.5%, but I think it's worth it, right? I think it's worth it. You're getting better returns and less volatility. Also, you get a nice 2.4% dividend yield. Annual turnovers are only about 15 to 20%, which is, I mean, overall, it's just like good. It's a well-run ETF. Also, they're destroying their benchmark. They've literally doubled their performance over their benchmark over the last 5 years. It's so impressive. Perth Dole is the founder. If you don't know, she's kind of a cool person. She's very knowledgeable. She genuinely, if you go listen to her talk, she really sort of knows what she's talking about. The ETF has also gotten over $1 billion in investments, which is just great. So yeah, that is the value proposition of FRDM. And I was looking at this just a little bit earlier. This is their actual holdings, by the way. So 22% is in South Korea, and these have been like the places to own in emerging markets. Genuinely, this FRDM is at $51 over the last 5 years. It's gone up 60%. Since its inception, it's doubled, and that's only been 6 years. It's had very good performance, especially over the last year, because it turns out that the places where you want to be invested are everywhere that this ETF is invested in. Another sort of funky thing that I was looking at earlier. This is this is the largest weighted. This is the largest weighted in the big ETFs. The red is Hong Kong and China, and the yellow is Korea and Chile. These are some of the biggest holdings in the emerging markets ETFs. And of course, this is just anecdotal. This is very cherry-picked data, but I just thought it was funny. Year to date, EWY, which is Korea, is up almost 100%, and Chile is up almost 60%. Meanwhile, China and Hong Kong are up like 30% respectively, which, like, fair enough. But if you go to the 5-year, brother, this outperformance is ridiculous. Over the last 5 years, these two, just Korea and Chile, two of the freest countries in the emerging markets world, have just wildly outperformed two of the largest in the emerging markets world, which is Hong Kong and China, over the last 5 years. And if you go to the last 10 years, again, China just barely starts to peak above, but the further out you go, it's like the outperformance is so stark, where you have over the last year, 3 years, 5 years, 10 years, the countries that are free, they just perform better. They're just built different, literally. again, I'm personally invested in FRDM, and I find it to be a very good, in fact, I have a jacket. I have a Freedom Indexes here. I have a Freedom Indexes jacket. The Freedom Index. Hoodie, I guess you could say. But so I'm definitely not biased in any way. 100%. Not biased in any way. But yes, this is the Freedom 100 Index. I think it's worth taking a look at. I think it's worth potentially investing in, because emerging markets have long been a thing that I've been an advocate for across, every channel I've ever had. I've always said, hey, you know what? It's great that you can invest in the United States, and it's great that the United States has great performance over the last couple of years. But it's important to sort of diversify, I think, outside the United States. And the best place to do that, I think, is in the emerging markets. And so the best ETF that I have found personally is the ETF that tracks freedom. It says, hey, you know what? If freedom is your priority, you'll grow quicker. And it is demonstrated over the last couple of years that that is indeed the case. Either way, this is a long report, by the way. It's crazy. And it's been very cool to see the growth of just this fund in general. It's awesome. It's awesome to see really good ideas that perform really well grow quickly. It's great. I'd love to see this. Also, I can appreciate that this fund does not charge exorbitant fees at like a 0.75% management fee. It's just 0.5%. It's pretty nice. Annualized since inception, 12%, and their EM benchmark is 7.6%. It's not even close. There's a little more volatility in this ETF specifically over the last couple of years. But I think that's just about all I really wanted to talk about in terms of emerging markets. In terms of this ETF specifically. I remember this sort of came out at the same time Discipline Funds came out, and unfortunately, there has been a clear-cut winner there's been a very clear-cut winner in terms of which ETF has performed better. Hang on. Whew. Man. Okay. I will outro this, and then we'll turn it into a YouTube video after stream. Yeah, and that's just about it for the Freedom 100 Index. Let me know what your thoughts on emerging markets are, and if you enjoyed this video, go ahead and subscribe and like the video. I didn't like that. Not at all. Oh, hey, look. And hey, if you enjoyed the video, let me know what your thoughts on emerging markets are, and drop a like and subscribe. Also didn't like that, but that's okay. We'll keep it. We'll keep it. We'll do it live. We'll do it live. Anything else interesting happening today? I have this other thing that I've prepared, which I don't know if we'll get to, but oil's going up. Uh-oh, time to go buy some gas. Yeah, the 2026 is going to be such a crazy year. January, the Fed is going to change. We're still going to have Trump as president. XP. With the Fed change? I don't know. What does XP do? This is a Chinese company. Financial services platform. They pay a dividend. My guess is that this is XP Finance. XP Finance. Wait, is this really what this is? Access documents. Is this really like you can bet on XRP? Wait a second. Give me a institutional presentation. Oh, R 2 billion. What? Oh, low fee financial products and services in Brazil. Brazil. $2 billion in client assets. 20 billion in revenue. Wow. How are they doing 20 billion in revenue when they only have 2 billion in assets? That's wild. 5th position in the ranking of the most valuable companies. My guess is they're talking about in Brazil. Leader marketplace in Brazil focused on banking disintermediation. Yep. Okay. Our history and recent evolution. Okay. Open-minded. Guys, they're open-minded. Thiago Mafra. Nice. Cayman Islands, a classic. That's how you know you can trust it. It's because they're based in the Cayman Islands. Our business. So it's a bank. It's literally just a bank. The vast majority of their money comes from management fees. Interesting. This is one of the most like nothing companies I've ever seen in my life. Now I'm sure they do great work. Their client growth is slowing down, but their client assets are exploding upwards. Total gross revenue. And they're doing pretty well. Well, okay. I thought this was some random Chinese company, but apparently not. Is it entirely affordable? I do not know. Maybe. What is this Grokyu? What is this? I thought they misspelled like the. Okay. What is this? It's a different Grok. This is the better Grok. Yo, McLaren. Grok is an official partner of McLaren. Devs trust Grok Cloud. I don't understand. They're talking. There's two Groks. There's two Groks. Chooses Grok for inference. Good lord, I was gonna say interference. That makes sense. What? Okay, all right. Anyway, so Nvidia is acquiring this company. Nvidia Grok deal is structured to keep fiction of competition alive. That's so tough. Oh, wait a second. Oh man. What am I thinking of? There's a I think it was a Goldman Sachs analyst. I gotta see if I can find this. Man, there was I think it was a Goldman Sachs analyst. They were talking about, they were on a conference call with some biotech company, and the biotech company was like, we have this new drug that is gonna do great and it's gonna cure a bunch of diseases or whatever, and one of the Goldman Sachs analysts gets on the phone and he's like, is curing diseases a sustainable business model? It's got to be one of the top 10 calls of all time. Genuinely. Um, this is a couple years ago. Is this where the meme came from? Is this where the meme came from of like, curing diseases isn't a sustainable business model? That'd be very funny if it was. Please give me a direct link. They were talking about Gilead Sciences, which, by the way, I think has performed quite well over the last couple of years. Yeah, since this report was written in 2018, they're up almost 100%. So clearly, apparently, curing diseases is a sustainable business model, it would turn out. Okay, give me this. I need it. Yeah, I get it. Just give me the link to the report. Is curing I like how they talk about the total addressable market of diseases. Address large markets. Hemophilia is a $9 to $10 billion market, growing 67% annually. What a classic. What a classic of an article. Goldman Sachs asks in biotech research report, is curing patients a sustainable business model? The genome revolution. Oh, the genome revolution. We should. Yeah, that'd be funny. The potential to deliver one-shot cures is one of the most attractive aspects of gene therapy, genetically engineered cell therapy, and gene editing. However, such treatments offer a very different outlook with regard to recurring revenue versus chronic therapies. While this proposition carries tremendous value for patients and society, it could represent a challenge for genome medicine developers looking for sustained cash flow. Gilead Science is a case in point where the success of its hepatitis C franchise has gradually exhausted the available pool of treatable patients, the analyst wrote. In the case of infectious diseases such as hepatitis C, curing existing patients also decreases the number of carriers able to transmit the virus to new patients. Thus, the incident pool also declines. Where an incident pool remains stable, e.g., cancer, the potential for a cure poses less risk to sustainability of a franchise. I love it. Solution 1, address large markets. Hemophilia is a $9 to $10 billion market, growing 6 to 7% annually. Or address disorders with high incidence. Spinal muscular atrophy affects the cells in the spinal cord, impacting the ability to walk, eat, or breathe. And constant innovation and portfolio expansion. There are hundreds of inherited retinal diseases. Pace of innovation will also play a role as future programs can offset the declining revenue trajectory of prior assets. Truly a classic of the game. Is curing patients a sustainable business model? Apparently not, says Goldman Sachs. You remember Pool Corp? I remember when Pool Corp was, where's Pool Corp now? I remember when Pool Corp was the stock to own a couple of years ago. I remember, yeah, what a classic of the game. 60%. I said around 400 that you shouldn't buy it, I think, because it was a little overvalued. And I was right. I got vindicated after it went up an additional 40%. But I was right. I'm never wrong. Most days. Unit. I need to do a full actual, like, big write-up on Unit again. Because it is a very interesting company, I think. Also, I want to take a look at this. There's a bunch of companies that sort of put out their stocks of 2026. Um, I think Morgan Stanley is crazy. They're like, you should buy the AI companies, and it's like, I don't think so. Um. Oh well, that's that. How's SFM doing? Sprouts Farmers Market. I used to own this. I used to own a lot of shares of this company. Wow, it's fallen a lot. I was buying around like $15 to $19 a share, and I was selling like 120s. Brother, I remember when Sprouts Farmers Market was like a $400 billion company. That's so long ago. $400 million company. One day it will be one day it will be 400 billion. But it might be, honestly, it might be worth taking another look at Sprouts Farmers Market, because I was buying when the PE was like 16, and now that all right, actually, yeah, let's take a look. So I started buying Sprouts Farmers Market a long time ago when the PE was like 9 or 10. Um, we're gonna run through their investor presentation. When was this? October of 25. I started buying Sprouts Farmers Market a bunch of years ago for $13-14 a share, and I was selling at 120. So I literally 10x'd my money, which was unfathomable, because I kind of got lucky a little bit. So it's a very quickly growing company, and their margins were expanding very rapidly, and they also were very easily able to hop on the trend of, during COVID, a lot of companies were doing the whole like digital delivery thing, and so Sprouts Farmers Market expanded, where it was able to expand very quickly during that time frame. So let's see how they've done so far since I sold all my shares. I think like 2 years ago. I did think one of the cool things about the company was they have like all of their own sort of deals. Like they have their own company, they have their own like boutique brands, which is very cool. One thing I did not like was all of their pictures are terrible. Bro, I remember brand penetration was like 12% when I started buying. Now it's literally doubled in the last 5 years. That's crazy. Good for them. And they talk about their actual store setup. Amazing. Consumers spend $1.6 trillion on food at home. Okay. They only want to target 290 billion of it. Okay. Good for them. They continue to attract younger customers and slightly higher educated. Okay. Skews higher income. Over half are married, typically dual income. That makes sense. It does make sense. Only 15% of customers were identifiable. Okay. Makes sense. Unique store experience. They love talking about their unique store experience, about how, it's actually a farmer's market, despite the fact that it's a big box store. E-commerce penetration is 14% of sales. I remember when it was 3%. So the actual fundamentals of the business are continuing to improve, which is good to see. They've expanded very far. I remember when they were just opening their first stores in Virginia. They got a bunch. Wow. And one of the other really cool things was they had this sort of deal where they were talking about their ability to take their distribution centers and have them very close to stores, or the turnaround time. A lot of grocery stores lose a lot of product because of turnaround times being so long for fresh food. But they were able to make make great strides in this area where their turnaround times were very low because of their distribution centers being so close to stores. 170 local farmers representing 19% of total produce sales. Yeah, this 80% 80% increasing of stores within 250 miles of a distribution center. Yeah, service achieved 99% controllable on-time delivery to stores. That's how they were able to do so well. Jack Sinclair, wait a second. Okay, he's still CEO. Good for him. I'm glad they haven't gotten rid of him. And it looks like most of the staff that works for most of the C-suite is still very much the same. Almost $21 an hour on average. That's insane. This is what I imagine looking at Buc-ee's would be. I want Buc-ee's to go public so badly. I need them to go public. Yeah, their earnings are still increasing very rapidly. Net sales, wow, they've added an additional $2.1 billion in net sales over the last 5 years. That's $400 million a year. That's about 10%. Okay, yeah. That's pretty decent. And they're earning 25%. A 25% compound annual growth rate on earnings is lunacy, I think. And the margin expansion, earnings increasing, and sales. Lord of mercy. Self-fund our growth and deliver shareholder value through ongoing share repurchase program. And they're rebuying shares. They're rebuying 400 million in shares. Now, granted, it's only 10% of shares now. Okay, never mind. Share repurchases are only 240 million. But that's a very small amount of actual operating cash flow. ROIC is improving. I also remember when ROIC was under 10%. So they're becoming more and more optimized. This is just wow. This company's even better now. It might be worth taking another look at this. Thank you. Wow. Thank you. Let's read their most recent press release. Let's talk about their company. We're opening stores nationwide, and our strategy continues to resonate with our target customers, resulting in strong third quarter performance, said Jack Sinclair, the CEO. Net sales totaled $2.2 billion, a 13% increase from the same period in 2024. So revenue is still growing at 13%. Comparable sales is 6%. Wow. That means comparable sales is when you take the sales of your stores. So hang on. Comparable same-store, this is same-store sales growth. So your existing stores are selling more, which is solid. Opening 9 more stores, resulting in 464 across 24 states. Very cool. They got $600 million more in credit, which insane that they're taking on $600 million worth of debt. Well, revolving credit facility. And their cash flow per quarter is about $600 million, so they can pay it off very easily. Ended the quarter with $322 million in cash and zero balance. Yo. They're buying back $1 billion worth of shares over the next couple of years. Cash from operations is $577 million and CapEx is $200. Wow. Okay, so fourth quarter, they're not looking much in terms of growth. Comparable same-store sales growth is not looking the best going into the next quarter. they're looking at a lot of. They're still looking at sustained growth, just not necessarily from store to store. Full year 2025 outlook. Okay. Net sales this is very big. Bigly. SG&A isn't going up that much. Current assets. This is what I'm curious about. Cash and cash equivalents. 322 versus 265 last year. Total currents 800. Total assets is 4. The vast majority of being buildings, operating leases. Total debt. The vast majority of their total debt is the long-term operating lease liabilities, which, okay. Long-term debt, basically no long-term debt. Total current liabilities, yeah, but this is all accounts payable and liabilities, which they can easily all cover. The vast majority of their debt is just leases on buildings, which is something else. They've basically they're growing revenue at 15% per year, and they're growing earnings at 25% per year, and they have no debt. Every time I look at this company, I go, wow. Is there a better company to invest in at this point? I think broadly, sometime in the new year, I think sometime in the new year, we're going to start talking. We're going to start a brand new portfolio. And we're going to track it. I think that'd be pretty cool. I do want to start the voted on portfolio though. I think that'd be so much fun. Maybe one day in the future, but obviously not right now. But I think it'd be very interesting to have a portfolio that chat votes on. Give me uno momento. Uno momento, por favor. Should I do this? Yes. Okay. That's exactly what I thought would happen. Okay. Okay, yeah. Espresso Farmers Market, very interesting company, I think. Yes. Okay. So that's Sprouts Farmers Market. I don't know. Additional reports. Proxy statement. Yeah. If you've never looked into Sprouts Farmers Market, I would highly encourage you to do so because it's always just a great company. I think it's just great all the time. I think that's gonna do it for me today. I'm going to head out, probably work on some videos. I want I want to spend the next week sort of more broadly thinking about, since I kind of want to take this a little more seriously, content-wise, I want to think about what I want to do, have a more concrete direction and plan about what I want to do and how I want to get there. But we'll still continue flying by the seat of our pants as we are apt to do around here. And so I appreciate everyone for hanging out. We'll be back probably Tuesday or probably Thursday with a nice long stream, I think. We're going to be talking about lots and lots of stuff. I got lots and lots of stuff planned. I'm very excited for the next couple of streams. I think the content's going to be great, but there's going to be YouTube. If you aren't subscribed, go subscribe to YouTube. There's videos literally every day. Not long-form videos, but there are shorts every day, and there are videos usually like 2 or 3 times a week. But thanks so much for hanging out. I do appreciate it. Oh. Dang work. Welcome back. I'm heading out. I want to do more planning. I want to do some thinking. However, yes, indeed. Yes, indeed. Yeah. I don't really have anything to, yeah. Anyway, thanks for hanging out. I'll be back probably Thursday with a nice long stream, talking about all sorts of stuff. But goodbye for now. Thanks for hanging out.